Welcome to our third webinar on SMSFs. We just want to talk about some of the trips and traps, I suppose, with SMSFs. And we've got Neil Stafford, Strategic Superannuation SMSF Services. We've got Archie, my compliance conspirator. And where do we want to start, gents? Where do you think's a good place?
Well, I think, thanks, Steve. Yes, so Neil's also our specialist advisor in complex advice.
Yep.
And he's been around with Shartru for a long time, Neil, haven't you?
Indeed, from 2014.
Yeah.
Coming up for
so many of you would have
come.
Many of you have come across him from time to time, and he's establishing a new strategic SMSF solutions business, which Rob has spoken about and will introduce later. But initially, I thought we should just discuss about reasons for establishing SMSFs, Neil, in particular, control of funds and some other dealings with death benefits and some exempt current pensions as being valid reasons for establishing SMSFs. What are your initial thoughts on that?
Look, there's been a lot of concentration on control of investments as one of the major reasons to start an SMSF. And from my perspective, that really only goes an initial way into the range of benefits that the SMSF structure provides to the clients and to the advisors. I look at a whole range of things. To me, an SMSF is a nice estate planning vehicle, and that links in beautifully with the other parts of a client's estate plan. The control of death benefits from an SMSF is able to be far more finely tuned than from a retail or industry fund. We can have tiered non-lapsing nominations, depending upon the deed. We can actually have certain binding death benefit nominations renewed by an enduring power of attorney, which you can't, to my knowledge, do through an industry fund. The tiering of nominations is particularly helpful because in the first instance, if something fails, we've got a fallback position. We've also got the capacity when people are in retirement pension phase to look at the control of taxation events such as capital gains on the sale of a property, for example. And we can capture that under the exempt current pension income rules very, very advantageously with a bit of forward planning. Again, you can't do this with an industry or retail fund. The other interesting thing from my perspective too is the control of the franking credits in retirement phase. We get a full refund of the franking credits if they're unused against any tax liability. This doesn't happen, in particular in an industry fund, because the industry funds...
Neil, also in the accumulation phase, I think that's another area that we probably forget is the control of the franking credits to offset maybe contributions tax and so on. So
true, absolutely right. Because of this control of franking credits at the fund level, pension clients in an industry fund are effectively subsidising accumulation phase clients, whereas in an SMSF, we have control over the payment of the refund. So to me, looking at the control issues with respect to investments, that's the first step. I think there are a whole series of strategies and benefits in looking further into the structure as a very flexible estate planning issue.
I suppose what we're trying to do, Archie and Neil, is everyone can say control, I got control of my investments when, and especially with some of the industry funds offering what I'd call a type of DIY perspective. So really, if you're only going to hang your hat on just one thing, then you're likely to be attacked. So we should be really, I suppose, singing the benefits of a self-managed super fund just beyond control of the investments.
Sure. And that's right. I mean, we see advisors recommending an SMSF because the beneficiaries have, through their trustees, the control over the fund. But in essence, what we're talking about here, some specific reasons why control is valid and valuable as a part of their recommended strategy. So great stuff, Neil. One of the other areas that we have concerns over when we're looking at work and seeing the advice around the traps is the consideration of the sole purpose test. Plenty of material on this provided, but let's consider acquiring assets for members' benefit and how that impacts sole purpose test, Neil.
Again, there's a number of issues. One of the famous cases in the past has been the Swiss chalet case, where
Showing your age there, Neil.
yes, I'm afraid I probably am. It was in the early 90s. But that's where an asset of the fund was being used for the benefit of the members. There's a belief in some circles that a residential property owned by an SMSF can be leased to a member on the basis that the member is a related party of the fund. Well, that's incorrect. It can't be, because that actually breaches Section 65 of the Act, and that's the financial provision of a benefit to a member. It just can't be done. So we've actually got to look very closely at what the sole purpose test is. And again, we can go through and have a look at that in its very basic form. It's there to provide either retirement benefits to a member, death benefits to a beneficiary of a member, and there's certain other ancillary benefits that go along with that, and they can be TPD, income protection benefits, etc., etc. It's not there to avoid those issues. The sole purpose test is to ensure that the superannuation structure is there to provide those types of benefits only. Again, there's a view that you can run a business within an SMSF. It's quite true, you can, but it's not to be the sole reason for the existence of that structure. So we have to have a look. To me, the sole purpose test is actually very, very important. And it's included in just about every deed that I've reviewed. And if it's not, it's deemed to be incorporated as a covenant. So it's an extremely important consideration for advisors.
Now we know, Neil, that APRA funds and specifically industry funds are really looking at the fees for advice and stuff like that go to those funds. And, you know, the sole purpose test, of course, is one of their reasonings behind that. But do you see, or do you think, I mean, I've formed a view that I think the tax office is starting to really start to look in this area. Do you think that's valid reasoning, or?
The industry funds, again, in my view, have concentrated a lot on the fees issues.
Yeah.
Not all of the industry funds are, in fact, all that cheap. If you go through and do your figures, a number of them are not particularly as inexpensive as they would like you to believe.
True.
There's been a view that the fact sheet that ASIC put out some years ago, looking at the fees associated with an SMSF, vastly overestimated the fees. There's been a number of research reports that have come out recently, and a view that it's eminently justifiable having a lower balance than ASIC might consider viable. However, given the capacity for control of various issues, the capacity of the flexibility of the structure, to me, the fees are justifiable. You're adding potentially considerable value to the beneficiaries of the fund and the beneficiaries of those members in terms of the structuring that you're able to do. So in my view, concentration on fees alone is really not a valuable addition to the argument in favour of SMSFs.
So one of the other areas that impacts on the sole purpose test is when there's an LRBA arrangement, the amortisation of the liability might exceed the time frame where the pension may commence. What are your thoughts on that and how it impacts the sole purpose test?
Again, we see a lot of SMSFs that have been established for the sole purpose of acquiring a property. Now, the use of terminology there is deliberate, because it's there really as part of a property acquisition scheme or arrangement, and it's not necessarily in the best interests of the members. There's nothing wrong with an LRBA itself if it's handled properly and if all due consideration is given to all aspects of the LRBA. In my view, if you start off an LRBA, you have got to have a very clear exit mechanism in mind. And an exit mechanism could be, well, what happens if we hit retirement? Should we still be in the LRBA? Well, if anybody's had experience dealing with transfer balance reporting issues and an LRBA with a member in retirement phase, it's a nightmare, absolute nightmare. But apart from that, you've got people who are not necessarily earning income in the retirement phase. You've got ongoing debt obligations. You really have to have this exit strategy in mind. How are you going to handle that? In the accumulation phase, you've got a whole series of issues. Do we need to continue to maintain insurance benefits so that we've got some funding if something happens to a member who's been subject to the LRBA arrangement? Again, a whole series of issues. From a wider financial planning perspective, if we look at the arrangements around LRBAs, I've yet to see an LRBA that doesn't have personal guarantees required from the members in their personal capacities. So even though the loan is with a different entity, you really have to look at the lending, the total lending over the client's, if you like, holistic base to determine whether or not that level of debt is just going a bit overboard. In many cases, I see it purely because there's an additional entity into which someone can leverage, that the leverage is done without due consideration to the other issues. But the exit mechanism is particularly important. What happens if a member dies? What happens if a member is unable to contribute or is made permanently disabled, for example?
Or
What
even
happens if in
worse.
the event of a divorce?
Yes. I was just about to say that, Neil. What happens in the event of a divorce?
Well, that's probably the worst of all scenarios because that's not something you can fund.
And it's also, and it's also quite emotional. And sometimes the property may have been purchased with the mind of retiring in the property.
Yeah, that has happened in the past, and that's where Section 65 of the SIS Act comes in. Either that, or the property is then sold to the member from the fund at market value, and provided we meet Section 109 arm's length dealing rules, then we're fine. But we're potentially incurring another round of stamp duty. So again, does that make sense from a total holistic financial planning perspective?
Absolutely. Also, we had some discussion around LRBA, some other practical issues, Neil, safe harbour considerations and purchasing assets in the correct name. There's other things that we see as some matters to consider in LRBA advice.
Correct. Regrettably in Australia, of course, each state jurisdiction and territory jurisdiction has its own specific requirements as to how a contract for the sale of land has to be settled. It creates a lot of problems. Each state has its own particular requirements as to how a contract needs to be phrased. And to actually get the structure established correctly. So I understand in Queensland, you must have the corporate trustee of the Bear Trust established prior to signing the contract. In Victoria, we've got an element of leeway because we can add a nominee clause to the purchaser's details on the contract. To my knowledge, I believe Victoria is the only jurisdiction that does that. So getting the documentation right from day one is, to me, absolutely vital. Far too often, we see people come and say, I've signed the contract, I've done this, but I want to buy it via a super fund. Okay, well, let's have a look at the documentation. Have you got the Bear Trust? Have you, in fact, got a super fund? Well, no. By then, it's possibly too late. We want to get every indication clear and correct in our minds before we actually enter into an agreement to purchase a property. There's a range of other issues. To me, the safe harbour guidelines, they're there specifically for related party loans. But from my perspective, what they do is give us a good idea about what the ATO considers to be reasonable in respect of an LRBA. There's limitations to the time frame for the loan. There's limitations as to the LVR, the loan to valuation ratio. There's a series of indicators that tells us what the ATO in its capacity as regulator feels is appropriate for this type of arrangement. Again, look, there is an argument that LRBA should never have been introduced in the first place. Well, back in 2007, the legislation was introduced. I described it at the time as effectively using a sledgehammer to crack a peanut in terms of providing a solution for a technical problem. Having said that, the legislation's there. It's legal to enter into these arrangements, but it needs to be done prudently and with due consideration to all of the appropriate matters.
I believe, recalling in 2007, that the original purpose was for business real property to be acquired through LRBAs.
That's certainly one of them.
Purpose. Mm.
But one of the things that was causing the ATO great angst at the time was instalment warrants, which were starting to be available through the stock exchange. Well, technically, there's an element of borrowing. You also had self-funded instalment warrants. The legislation didn't take all this into effect. So after a period of consultation, the ATO came up with amendments to Section 67. And the argument is, look, they've gone too far. They have. They've subsequently tried to bring back the effect of the legislation. But as I say, the structure is still legal, and provided that it's prudently done and with sufficient foresight, then there should be no issue.
With the LRBAs, Neil, what's your view on one of the things I think Archie and I see is there doesn't seem to have been any thought to the cash flow. And, when I say that is, it looks good year one, but no one's looked to see whether year 5 there's going to be enough funds there and things like that.
Well, again, this comes into considering what the exit mechanism is. What happens if certain events don't happen?
Yeah.
I would imagine, Steve, that in many cases you see LRBAs totally reliant on subsidisation of costs through contributions, whether they're concessional contributions or non-concessional contributions. The issue there would, of course, clearly be what happens if those contributions can't be made? How do we manage the cash flows? Does that provide such an impediment to the prudent operation of the fund?
And that the property is rented.
Yeah, correct. This is just yet another consideration. And don't forget, as part of the investment strategy, we have to take into account the solvency and liquidity of the SMSF. Now, again, most of the time you would see the issues associated with solvency and liquidity mentioned in the trust deed. But because they're covenants of a fund, they don't have to be, but they're deemed to be incorporated in the fund. So the issue of solvency and liquidity, they're primary considerations when you're looking at an LRBA arrangement.
Thank you, Neil. Very insightful, and we've covered a little bit today, but I think it's an opportune time to introduce the new venture that Neil is heading, and that is really to navigate all of us through all the complexities of SMSFs and the advice therein. So Neil, I'll let you have the floor and introduce your new venture.
Oh, thanks, Archie. Rob Coit came to me late last year with a proposal to start off a new entity under the Shartru umbrella, and we've established that, and it's referred to as Strategic SMSF Solutions. We're very close to launching that to all of the advisors, but there's really 3 parts to the offering under that new entity. We're looking at providing a white label administration and taxation service so that we can provide a consistent level of tax and accounting with SMSFs across the network if you wish to participate in that particular part of the offering. What we have seen is, I think to politely put it, a variable standard of accounting in some of the SMSFs that have come across my desk from accountants across Australia. From my perspective, some accountants don't do enough in the SMSF space to be fully experienced in how to account for them correctly. So this is one way that we're going to be able to offer a moderate cost, consistent service of accounting and administration in the SMSF sector. Secondly, it gives us the opportunity also to be able to create documents consistently across the network from one particular supplier. Some of you may be aware that Now Infinity acquired TopDocs over the past 7 months. It's been an interesting acquisition because Now Infinity doesn't appear to know what to do with TopDocs and some of the better documents in their suite. We've looked at Now Infinity in depth, particularly, of course, for some of the advisors who are dealing in UK pension transfers who require a QROPS compliant deed. I sat down with a provider of deeds the other day to go through quite a number of issues, and we'll be signing an agreement for the provision of SMSF documentation at very reasonable prices through that particular service, which is available through Strategic SMSF Solutions. The third part of the offering that we're looking at is to be able to provide advice and support to advisors across the network in respect to SMSF issues and advice. So we're there to support any and all advisors with answering queries, looking at technical issues, assisting in writing advice. There are some advisors out there who are yet to qualify to be able to write SMSF advice. I'll be there to help in writing that advice and effectively co-authoring an SOA and being responsible for the SMSF advice and supporting the advisor in the production and presentation of that advice. We're also there to look at very specific single issues, and it could be that I write the technical detail that would be included in an advisor's SOA, or work with the advisor to deal with quite complex issues and to either co-author an SOA, or in some cases I've actually written the SOA in my own capacity as an authorised representative of Strategic SMSF Solutions. So there's quite a range of activities, and basically I would like the advisors to see the new business as there to support their capacity to be able to give good, effective SMSF advice to their clients. I'd also say that I work on the basis with my clients that no question is silly or stupid, and you should never feel inhibited about calling to ask a question.
Excellent,
Ever.
Neil. And the practical use of the business will be discussed, and the information will be provided at a later date on how the engagement process between the ARs and that business. But what it will enable, particularly Steve and I, is to make sure that the advice that is now being given is fully compliant and meets the standards required, both from a regulatory body and ourselves. So that's the exciting part for the networks, Steve, don't you think?
Yep. And I think also it'd be exciting in the fact that if people work with Neil, they themselves will increase their knowledge and will have far better knowledgeable practitioners, especially in the area of SMSF. And I think from what I've observed, we've got plenty of people that are sort of dabbling in SMSFs, but like anything, if you're not doing it all the time, you don't know all the rules. You might only see vanilla type stuff, but also I think it's good to know you've got the backing of Neil, but you've also got the opportunity to learn and get to know some of the stuff that he knows.
And further on down the track,
osmosis is what I call it. Get a bit of osmosis going where we're able to,
share the knowledge.
Known as, Shartru Wealth. You want an SMSF? Shartru Wealth is where you go.
Well, the other thing that I hope we get into down the track, and we've discussed this, and I've discussed it with Rob, is a closer integration with the advice services and estate planning. To me, it's one of the most valuable parts of the relationship that we have with our clients, is the capacity to be able to draw in the next generation into their parents' estate plans and to deal with the very efficient and effective intergenerational wealth transfer arrangements.
I'd agree.
Wonderful, Neil. Thank you.
Thanks a lot.
And thank you all for joining us in the third webinar. We will continue to update you with SMSF advice and deep instructions on what we might need to cover off in the future, but we look forward to Neil providing us with all the guidance that we need in this particular area. So thank you all, and thank you, Neil, in particular, for joining us for this webinar.
Thanks very much indeed.
Thanks, Neil. Thanks, everyone.
Thank you.